You have spent 40 years doing everything right. You paid off your house, you maxed out your retirement accounts, and now the IRS has a rule that forces you to pull money out of those accounts faster than you planned, whether you need it or not, and quietly hand over tens of thousands of dollars you did not have to lose. Most people find out about this rule after it starts costing them money. I am going to show you exactly what it is, who it hits hardest, and the one move that can cut the damage legally before it is too late. The rule is called a required minimum distribution, an RMD. If you have a traditional IRA, a 401k, a 403b, or almost any other tax-deferred retirement account, this rule applies to you. Here is the simple version. When you contributed to those accounts, you got a tax break. The IRS let you defer taxes for decades, but it is always planned to collect, and once you hit a certain age, it stops waiting. Right now, for most people, that age is 73. Every year after that, the IRS calculates a minimum amount you must withdraw, based on your account balance and your life expectancy. Your bank may do the math for you, but you are legally responsible for getting it right. And here is the part that surprises almost everyone. It does not matter if you need the money. It does not matter if your investments are growing. It does not matter if you want to leave it to your children. The IRS has already decided. You must take the withdrawal and you must pay income tax on it. Not capital gains tax, not a special retirement rate, ordinary income tax. The same rate as if you had earned it at a job. Here's where it gets expensive for ordinary retirees. Let us say you and your spouse are collecting Social Security and a small pension. Your combined income sits in a comfortable, lower tax bracket. You are doing fine. Then you turn 73 and your first RMD arrives, say $15,000 from your IRA. That $15,000 gets added on top of everything else. It can push you into a higher bracket. It can make more of your Social Security taxable, and it can trigger something called IRMAA, a Medicare surcharge, that raises your Part B and Part D premiums 2 years later. One forced withdrawal, 3 separate tax hits, and the worst part? You did not want the money. The IRS required it anyway. This is not just a problem for millionaires. A $200,000 IRA can create exactly this situation for a modest retiree. The balance does not have to be enormous. The timing is what matters. Let me tell you about a couple I worked with. I will call them Robert and Elaine. They had done everything financial advisors tell you to do. They maxed contributions for years, paid off their home, and built about $850,000 in traditional retirement accounts by their early 70s. Comfortable, secure. Nobody ever talked to them about RMDs. When those withdrawals began, the required amounts were large enough to push them into a much higher tax bracket than they had ever been in while working. Their Social Security became more taxable. Their Medicare premiums jumped because their income crossed the IRMAA threshold. And because they did not actually need the cash, they were reinvesting most of it in a taxable account, meaning they were paying taxes just to move money from one pocket to another. When we reviewed their situation together, I had to tell them, if we had done some planning 5 years earlier, this would look very different. Robert looked at me and said, "I wish someone had explained this before we retired." That is why I am making this video right now. Not to scare you, to give you the information before the deadline arrives. I am Walter Barron. I'm a licensed estate attorney with more than 15 years helping regular families navigate retirement accounts, probate, and government rules that nobody explains clearly. I do not sell investments or products. My only job is to help you protect what you worked for. Here is a situation that catches surviving spouses completely off guard. When a spouse dies, something painful happens to the tax math. You go from married filing jointly, with its wider, more favorable brackets, to single filing status. The brackets shrink. The same income now gets taxed at a higher rate faster. I had a client named Carol. Her husband had handled all the finances. They had been careful savers their whole lives, building traditional IRAs together. After he passed, she inherited his account and continued taking the required withdrawals. But now she was filing as single. Those same withdrawals, the same dollar amounts they had always planned around, pushed her into a higher bracket she had never been in before. 2 years later, she received a notice that her Medicare premiums were increasing. She told me, "I thought I was being careful. I had no idea the rules changed so much after my husband died." This happens constantly. A surviving spouse is already managing grief and paperwork and completely reshuffled finances. The tax surprise should not be part of that. If you have a spouse, make sure both of you understand where the accounts are and what RMDs will look like for the survivor. That conversation is a gift you give each other right now. Here's the good news, and stay with me here because this is the part most retirees never hear until it is too late. There is a legal strategy that can reduce your future RMDs, keep you in lower tax brackets, protect your Social Security from extra taxation, and leave more to your heirs. It is called a Roth conversion. Here's the idea. You take money from your traditional IRA, move it into a Roth IRA, and pay the tax on that amount now. Yes, you pay now. But by shrinking the traditional IRA balance, you shrink your future required withdrawals. And Roth IRAs do not have lifetime RMDs for the original owner, so the money can keep growing. The key word is gradually. Most people do not do this all at once. You convert a portion each year, enough to use up your lower tax bracket without pushing you into a higher one. Done over several years, the strategy can dramatically reduce the forced withdrawals that hit later. The best window for this is usually between the year you retire and the year you turn 73, especially if you are delaying Social Security. During those years, your taxable income may be at its lowest point in decades. That is your opportunity. I have seen families save substantial amounts over a 20-year retirement simply because someone had this conversation with them at 65 instead of 75. This is not a one-size-fits-all move. The right amount to convert each year depends on your current bracket, Medicare thresholds, and your specific accounts. But for many retirees, it is the single most powerful tool available, and most people never use it. One more strategy that almost no one knows about. If you are 70 and a half or older and you give to charity regularly, listen closely. You can direct money from your IRA straight to a qualifying charity, up to an annual limit set by law, and that amount can count toward your RMD without ever showing up as taxable income. It is called a Qualified Charitable Distribution, or QCD. Here is why it matters. Normally, you would take the RMD, pay income tax on it, and then write a donation check. With a QCD, the money goes directly from your IRA custodian to the charity. It counts as your required withdrawal, and it never touches your taxable income. That means no higher Social Security tax, no Medicare surcharge. You just help the cause you care about while reducing your tax bill at the same time. The rules matter. The check must go directly from the institution to the charity, and not all organizations qualify. But for anyone who donates regularly, this is one of the most underused tools in retirement planning. Here's what I want you to do this week, not someday, this week. Step 1, pull every retirement account statement you own. IRAs, old 401ks, 403bs, SEP IRAs, all of them. Write them down in one place. I have seen people miss RMDs simply because they forgot about an old account from a former employer decades ago. The IRS does not accept "I forgot" as a reason to waive the penalty. Step 2, contact each account custodian and ask one question. What will my required minimum distribution be this year or next, and is my account subject to RMD rules? Step 3, look at last year's tax return. Find your taxable income. Find your Medicare premium amount. Check whether future RMDs could push you across a Medicare threshold, because those surcharges hit 2 years after the income that triggered them. Step 4, if you are between retirement and age 73, book a conversation with a qualified tax professional specifically about Roth conversions. Come prepared with your account balances and your expected income for the next several years. Step 5, if you donate to charity and you are 70 and a half or older, ask your IRA custodian about qualified charitable distributions before your next required withdrawal. Free help is available. Your state's SHIP office, the State Health Insurance Assistance Program, can help with Medicare-related income questions. The IRS-sponsored VITA program and AARP Tax Aid both offer free tax help for seniors. You worked for this money for decades. A traditional IRA is not entirely yours in the way most people assume. Part of that balance effectively belongs to the IRS. Taxes have never been paid on it. A $500,000 traditional IRA is not $500,000 in your pocket. The after-tax number depends entirely on when you withdraw, at what rate, and whether you planned ahead. The goal is not to avoid taxes illegally. The goal is to avoid unnecessary taxes legally, so more of your retirement savings stays where it belongs, with you and your family. If this helped you see RMDs clearly for the first time, watch the next video on this channel. I cover the most expensive retirement tax mistakes I see families make every year, and several of them are completely avoidable. And share this with one person you know who is over 60. There is a real chance nobody has ever explained this to them.